Okay, I hope I'm audible to all my students who are attending this particular lesson for the Cambridge International AS Economics course. In this particular lesson, I'm going to continue with the discussion of the first chapter within the macroeconomy module. This is national income statistics. Now, all my students can recall that in the previous lesson on this particular concept, we had talked about what is meant by national income. We had also talked about the difference between gross domestic product and gross national income. And we had also talked about gross national disposable income. We had talked about all these terms in the previous lesson. We had also learned that national income is essentially a flow concept because you measure it over a period of time. Okay, now in this particular lesson, we are going to talk about what are the various ways of calculating or measuring national income. Now, there are three approaches using which we can capture the national income of a given economy. The first one is the product approach, the second one is the income approach, and finally, we have the expenditure approach. And in terms of theory, all these three approaches should on paper give you the same figure for national income. Okay. Obviously, there are some measuring errors, what we also call as statistical discrepancy, where you can see that the national income calculated using the product method might be different from the national income calculated using the income method. But in terms of the theory, the national income using the product, income, and expenditure approach should give us the same answer. Okay. So in this particular lesson, I'm going to talk about these three approaches in detail. All students who are attending this online lesson, make sure that you are making notes, because these notes are going to be immensely helpful in answering your essays, in helping you revise the concepts when you're doing your self-study. Okay, so let's quickly start with the discussion of product, income, and expenditure approach in this particular lesson. So I'm just writing the main heading for completeness. We are looking at Cambridge International Education, AS Economics course. Okay, we are looking at the macroeconomy module. This is the main module, the macroeconomy. And within this, the chapter we are discussing is national income statistics. National income statistics. So let's look at the methods of measuring GDP. Methods of measuring gross domestic product, short form GDP. Okay, so I can write that there are three ways. There are three ways of calculating GDP. There are three ways of calculating GDP: output, income, and expenditure method. Output, income, and expenditure method. Each method should give the same total, GDP, because they all measure the circular flow of income. They all measure the circular flow of income produced in an economy. I will be discussing more about the circular flow of income in the next chapter, because the next chapter after national income statistics is nothing but the circular flow of income. Circular flow of income simply tells you that whatever the firms are going to produce, will ultimately be purchased by the households. Okay, and whatever inputs are needed by the firms are provided by the households. So households provide land, labor, capital, and entrepreneurship skills to the firms. The firms are going to use these inputs or factors of production to make final goods and services, which are ultimately sold to the households. That means whatever output is produced by the firm will generate equivalent amount of income for the firm, and whatever is the income for the firm is exactly the expenditure of the household. That means on paper and on theory, all these are ideally equal. Output, income, and expenditure are equal to each other. Okay, so I can write, so the value of output, is equal to the incomes that are earned producing it. The value of the output is equal to the incomes that are earned producing it. Okay, and these incomes include what? I can write meaning wages, rent, interest, and profits. So the value of the output is nothing but the sum of all these incomes. Okay, and then I can say that if it is assumed that all incomes are spent, you are not saving anything. That is the assumption. That means whatever you are earning, you are spending every penny of it. So if it is assumed that all the incomes are spent, expenditure by definition will be equal to income. Expenditure by definition equals income. So if I sum up the whole paragraph, we are simply talking about the fact that income, output, and expenditure will come out to be exactly equal. Whatever output is produced by a firm will generate income. Okay, this income will be given back to the workers in the form of wages, rent on land, interest on capital, and profits to entrepreneur. That means the value of the output will exactly be equal to the sum of wages, rent, interest, and profits. That means output and income are equal, and this income which will be earned by the households through wages, rent, interest, and profits, this income will finally be spent. Every penny of it will be spent by the households. We are assuming that the households will not save anything. Whatever income the households are going to earn in the form of wages, rent, interest, and profits will ultimately be spent by the households, so that expenditure will equal income. Okay, so that means all three are equal. Now let's look at all these approaches individually. So if I erase all this off, let's look at the output method. Output method. So I can write the output method measures the value. It measures the value of the output produced by industries such as manufacturing, construction, hotel, and catering, and one more example could be agricultural sectors. So when we talk about the output method to capturing GDP, it is going to measure the value of the output produced by all these industries, be it the manufacturing sector or the construction sector or the hospitality sector or the agricultural sector. Okay, so I can say it is also sometimes called, the production method. The output method is also called the production method or the product method. Okay, now the important point to understand is when you are measuring GDP using the output method, you must take into account only the final good. If you are taking into account intermediate goods, that can lead to a problem of double counting, because the value of the intermediate good is automatically included in the final. So intermediate inputs should not be included. So let me make our students write a point on this. So I can write, when using the output measure, it is important to avoid counting the same output twice. It is important to avoid counting the same output twice. For example, if the value of cars sold by the manufacturers is added to the value of output, of the firms which make tires, double counting will occur, because the value of the tires is automatically included in the final value of the car. So what I'm trying to say is that value of the car automatically includes the value of the tires. So to the value of the car, if I also add the value of the tires used by the firm, it will lead to double counting. You're counting the value of tires twice, because the value of tires is automatically included in the value of cars. Okay, so I can say that therefore to avoid double counting, output is measured by either totaling the final value, or I can say either totaling the value of the final goods and services, either by totaling the value of the final goods and services produced, or by adding value added, at each stage of production. So students, what I'm trying to say is, when you want to calculate the GDP using the output method, there are two approaches. Either you take into account only the value of the final output, or what you can do is you can take value added at each stage of production. Okay, so now let's understand what is meant by value added, and I'll explain this through an example. So now I'm erasing the initial paragraph off. I hope students are making notes along with me. So I can write that value added Value added is the difference between the price a firm pays for the goods and services it buys from other firms and the price it sells its product for. The price at which it sells its product for. So value added is what? The price at which I'm selling the final product minus the price at which I've bought it from the previous firm. I repeat, value added is simply the difference between the final price at which I'm selling the product minus the price at which I buy it from other firms. That is the value added. Okay, so if I take an example to explain it, so what we are trying to say is, students, we are trying to say that either to calculate the GDP using the output method, either you should take into account the value of the final good or just add up the value added at every stage. For example, either suppose I am a pizza manufacturing company, so either I am going to take the final value of the pizza I'm selling to the customer, or I just calculate the value added at every stage. For example, there's a bread. From the bread we make flour. From the flour we make bread. From the bread we make the pizza base, etc., etc. That keeps on going. So I'm adding value added at every stage, or I'm taking into account just the final value of the good. So let's take an example to understand this. If I erase all this off, I can write that, for example, a TV manufacturing firm buys components costing $280,000 and uses them to make TVs that it sells for $350,000. So a TV manufacturing firm has bought components worth this much, and using these components, the TV manufacturer ultimately makes a TV, and this TV is sold in the market for $350,000. So how much is the value added? So I can say value added by the TV manufacturer. The value added by the TV manufacturer is equal to the final value of the output, which is $350,000, minus the cost of purchasing those components, which is $280,000. That means the value is $70,000. This is the value added by the TV manufacturer. So I can say adding, therefore adding the value at each stage of production should give the figure as the market value of the finished good produced. Market value of the finished good produced. Okay, That means at every stage of production, if I just keep on adding the value added, the sum of all those value addeds will give you the final value of the output. So I can erase the initial portion off and I can write this on the top. Sum of the value added, sum of the value added at every stage of production. If you sum up the value added at every stage of production, you get the value of the final output. Value of the final output. So when you are measuring GDP using the product approach, either take into account the value of the final output sold to the customer, or just sum up the value added at every stage of production, because both are equal. Okay, so hoping students have understood this, but you should never make the mistake of adding intermediate inputs to the final, because if you're doing that, you are creating a problem of double count. So to avoid double counting, either take into account the value of the final output or sum up the value added at every stage of production. Okay, so this was the output method. Erasing all this off, the second method we talk about is the income method. The income method. So now the value of, I can write the value of an output produced. The value of an output produced is based on the costs involved, in producing that output. Okay, the value of the output produced is nothing but the costs involved in making that output. What are the costs for any output? What are the costs? You have to pay wages to the workers, you have to pay rent on land, you have to pay interest on the capital you have acquired like machinery, and you have to pay back the profits to the entrepreneur. So I can say that these costs include wages, rent, interest, and profits. All these payments represent income paid to the factors of production. All these payments represent the incomes paid to the factors of production. For example, workers receive wages. And entrepreneurs receive profits. Okay, so in income method, you are adding the income of all those people or firms which are involved in making the output. Wages are the income of the workers. Rent and royalty are the income of the people or the households who are providing land as a factor of production. Interest is the income on capital. Profits are nothing but the income of the entrepreneur. So you add all these incomes, okay, which helps you in estimating the GDP using the income method. So I can write that in using the income method, it is important to include only payments received. It is important to include only the payments received in return for providing a good or service. In return for providing a good or service. So when you are talking about the income method, you should only include those incomes for which either a good or a service has been produced. All those transactions which do not lead to production of good or service are not a part of income method. So income method strictly only includes all those transactions where income has been generated because of either a good being produced or a service being produced. If no good or service has been produced, it's not a part of income it's not a part of GDP using the income method. For example, transfer payments. Transfer payments are transfers of incomes for which no good or service has been produced, like taxes. Okay, so I can say, so transfer payments which are transfers of income from the taxpayers to the groups of individuals for welfare payments and to the firms in the form of subsidies are not included. So what I'm trying to say is that if you are making transfer payment, like for example, suppose I'm paying taxes to the government. If I'm paying taxes to the government, it's a transfer payment. No good or service has been produced. If I pay taxes to the government, no good or service has been produced. If the government provides a subsidy to a firm, no good or service has been produced against that transaction. Although eventually subsidies might motivate firms to produce, but that's a separate thing. When the government is providing a subsidy or a welfare payment to a firm, it is motivating the firm to do more production, but that subsidy itself is not leading to production of good or service. Remember, motivation is different from production. Suppose I am a firm and the government gives me a subsidy, I will be motivated to produce more. But when the government is giving me a subsidy of, let's say, $100,000, I'm not producing goods exactly of $100,000. Similarly, when I'm paying a tax as a citizen of my country, when I'm paying a tax to the government is not producing an equivalent amount of good or service. Obviously, when I'm paying tax to the government, that will fill up the tax revenue of the government, and the government hopefully might be using this money to produce good or service. But I don't know what the government is doing with my money. No one knows how much of your money is channelized by the government in productive expenditure. Okay, so transfer payments are not a part of GDP using the income method, because when you're making transfer payments, no good or service has been produced. Okay, so transfer payments are excluded from GDP while calculating using the income method. So this sums up the income method approach. The last one, expenditure. The expenditure method. Now we are just going to add up the expenditures made by all those involved, like households, firms, government. Households make expenditure, government does expenditure, Firms do expenditure, foreigners do expenditure, we also spend on foreign goods. So I can say that using the expenditure method, GDP is calculated by adding up the consumer expenditure government spending. Consumer expenditure is nothing but what the household spend on buying goods and services. Government spending includes expenditure done by the government on producing goods and services. So government spending on goods and services. It also includes investment done by the firms. Investment denotes firm spending on capital goods like machinery. So total investment. It also includes changes in stock. Changes in stock is going to capture how much additional stock is added to the economy in a given year but not sold. So it's the closing stock minus the opening stock. In the bracket, I can write closing stock minus the opening stock. This includes the stock of unsold goods, which were produced in that year but not sold. So this is a part of inventory investment. You are building up on inventories. These inventories are going to add to the future productive capacity of the economy. That means these are those goods which have been produced in that year but not sold. They have been produced but not sold. So they are going to add to the productive capacity later. But since they are goods being produced in that year, they should be added to the GDP using the expenditure approach. So that's changes in stock and the difference between exports and imports. And the difference between exports. Now, exports denote foreigners spending on our goods. Imports denote the home citizens spending on foreign goods. Okay, so I can say that therefore GDP is equal to consumption expenditure by the households, government expenditure on goods and services, investment done by the firms, foreigners spending in the form of exports on our goods. Why are we subtracting imports? This is exports. M denotes imports. Why are we subtracting imports? Because imports denote part of our income spent on foreign goods. So it's expenditure done abroad. It's going to go abroad. It's not expenditure. When we talk about expenditure method, expenditure done on our goods, domestic goods. Imports does not capture expenditure on domestic goods. Imports capture expenditure done on foreign goods. That is why we are subtracting it. C denotes consumption. G denotes government expenditure. I denotes investment. X and M denotes exports and imports. So the GDP using the expenditure approach is C plus I plus G plus X minus. And this is also, by the way, called the national income identity. Okay, so hoping students have understood this. Again, we should not include transfer payments because no good or service has been produced. So again, I can write a note that transfer payments are not included. Transfer payments are not included. Okay, as it does not represent spending on goods and services. Transfer payments do not correspond to expenditure on goods and services. Expenditure approach only talks about including all those expenditures which are either done on goods or services. When you are making transfer payments, no good or service has been produced against that. That means it's not a part of GDP using the expenditure method. Okay, so with this, we are done with the expenditure approach also. So I stop in this particular lesson. The objective of the lesson was to go into the depth of methods for measuring GDP. If I sum up the lesson, we have talked about three methods. Output method talks about including the final value of the output produced or the value added at each stage of production. Both will give us the same answer. We should not include intermediate goods in the output method because that will lead to a problem of double counting. Income method simply talks about summing up all the incomes received by the factors of production, which is wages, rent, interest, and profits. One should not include transfer payments in the income method because no income has been generated. No good or service has been produced. In case of transfer payments, no good or service has been produced. Expenditure method also talks about estimating the GDP by adding up the expenditures done by households, government, firms, foreigners. Why are we subtracting imports? Because they represent expenditure on foreign goods, not domestic goods. And when we are looking at the expenditure method, we are looking at expenditure done on domestic goods. Expenditure method talks about expenditure on domestic goods, not on foreign goods. And imports capture expenditure done on foreign goods. That is why we are subtracting imports. Again, we do not include transfer payments because they do not correspond to expenditure on goods and services. Transfer payments are mere welfare payments. No good or service has been produced. Okay, so I stop in this particular lesson. I hope it was an informative lesson for everyone attending it online. Okay, in the next lesson, I'm going to talk about the difference between market prices and basic prices. Market prices versus basic prices. Basic prices are also called factor cost. Okay, so I repeat for all the students who are watching these online lessons, remember this is not the complete lecture material. To subscribe to my complete course for Cambridge International AS Economics, please get in touch with me on WhatsApp. The WhatsApp number has been provided to all those students. If you check out the details below this video, you will check out my WhatsApp details. Please get in touch with me on WhatsApp regarding how to enroll for the complete course for Cambridge International AS Economics. Okay, so in my complete course, not only do I just talk about the theory part, but we also do a lot of practice of the exam style questions like the MCQs, like the essay and the data response questions. So you get you avail all this only once you have subscribed to my complete course for Cambridge International AS Economics course. I stop in this lesson. I hope students have enjoyed this lesson. Any doubts, you can unmute your mic and ask, or you can get in touch with me for doubts on call or WhatsApp, or you can mail me your doubts at divineschoolofeconomics@gmail.com. This is where I stop in this particular lesson.